It's a couple minutes past 11. I think we'll give just another minute to see if anyone else comes in, and then we'll get started. This is the negotiating term sheets, what's best for the company, what's best for you session, in case anyone's trying to make sure they're in the right room. I think we could probably get started. So I thought we'd just start off by introducing ourselves on the panel here, give you a sense of who it is that's speaking, and then we'll run through a brief overview of what it is we're going to talk about today, and then get right into it. So to start off, I'm Jonathan Ersprung. I'm a corporate attorney at McDermott Will & Emery. I mostly represent early stage and sort of mid-life cycle startup companies in the life sciences area and investors in life sciences, doing financings, M&A transactions, strategic partnerships and other sorts of collaboration agreements, that sort of developmental work for life sciences. And this is my second year presenting at Resi, so hopefully if any of you were here last year, you may have seen our similar presentation on term sheets then. This year we're going to have a slightly different focus, a little bit more on the equity compensation side, but hopefully not too much overlap with it, but still a lot of good information. And I'll turn it over to Joe.
My name is Joe Erwitz. I'm a partner in McDermott Will & Emery's executive compensation practice. I focus a large part of my practice on helping early stage life sciences companies design appropriate equity award arrangements. Have been practicing for 13 years in the field.
Thanks, Joe. I'll turn to Hugo.
Hi, my name is Hugo Peris. I'm the founder and CEO of Spiral Therapeutics. Before that, I have a background in family office, family business back in Spain. I've been involved with the family business at a board level for a few years now. And before founding Spiral in 2016, which the company is based out of San Francisco, I lived in China for 5 years in Shanghai, where I built Luca Pharmaceuticals, which is a pharmaceutical company for Western healthcare products coming into China. A successful business that is now being operated by somebody else. But it's a pleasure to be here today, and thanks for being here.
And Paul Toomey.
I'm with Wells Fargo Advisors. Our focus is equity compensation, stock options for executives. We also manage money for some family offices, and for the small companies we focus on exit planning, helping business owners and executives monetize their concentrated holdings in their companies. Thank you.
Great. So as I said, just sort of as a general overview of what we'd like to talk about, it is a section on term sheets generally, but I think the thrust of what we'd like to talk to you today about is sort of how you navigate the term sheet process, taking in new money into a startup company with an eye to executive compensation, equity compensation matters for new employees, existing employees, and sort of setting yourself up at the earlier stages in order to make sure that as you grow as a company and take on new investors or contemplate an exit of one sort or another, you're in the best position possible to incentivize and sort of bring in the right talent and properly reward and sort of compensate people for the work they do to bring the company to that point. So that's sort of the overall hope here. We're going to start with some more general term sheet topics and then drill into a little bit more of the specifics around how equity comp works. And I do want to say, we got a pretty good group here, both behind the table and in the audience, and I'd love to sort of keep this as a conversational format. So if you have questions as we're talking, feel free to raise your hand, and we'll try and work that into the discussion as well. I don't think we need to hold questions at the end unless it gets a little bit too much, and then we'll figure that out. But I think for now that's the approach. So I think we'll kick things off with a quick discussion of sort of what a term sheet is, what you're thinking about when you're negotiating with a potential investor, and the sort of what I think of as the two big picture pieces that most entrepreneurs and most finance people are thinking about when they get into that process. And that is, on the one hand, the economics of a deal, and on the other, the sort of other non-economic decisions like control decisions. You know, your board composition, your veto rights or decision-making authority, approval processes, and included within that, and sort of between the two, would be how do you hire new employees? How do you make decisions about an equity compensation plan and the awards you might give? So I'd like to start off by asking Hugo, our CEO on the panel, sort of, I'm sure you've been through this process a number of times, and you know, how do you start thinking about a term sheet when you're first talking to an investor, or you're sort of first thinking about the financing process? What goes through your mind?
Well, first of all, two very different approaches. The one is, the first approach is the more friendly one, which is the one that happens when your existing investors are still willing to back the company, and you can negotiate in a friendly way with them because these are people that you already know, so there's no need to play games. That's usually the way that I prefer to negotiate a term sheet. The second way to negotiate a term sheet is to wait until you find that institutional investor where there's not that deep relationship with, and you have to play more of that game of you know, just back and forth, generating a little bit of tension. So those are the two approaches that I've encountered before. And in terms of how you go about negotiating those term sheets, basically, in the first case, when negotiating with existing investors, typically what I prefer to do is to take the first approach or offer the first term sheet, a template where we feel comfortable and we feel that we are protecting the interest of the investors. Otherwise, you will wait to get the term sheet from the institutional and see what they come with. Usually, in that second scenario, the negotiation is a little longer and a little bit more cumbersome, and you end up leaving more things on the table. But that's a little bit of the differentiator approaches that I've taken in negotiating term sheets.
Excellent. And I'd like to just sort of think, I don't know, maybe it's good to get a gauge of the audience. Do we have mostly investors, entrepreneurs here? Or if you guess we could see a show of hands for who's here as a CEO or founder of a company or similar. So mostly on the company side. Do we have any investors in the room? Excellent. Well, I guess we know where the attention after the session is going to be. So, and I guess to follow on that, for the companies in the room, are you mostly, so can I see hands for anyone who's sort of pre-Series A round financing? Excellent. Okay, great. So maybe it makes sense then to talk a little bit about, and again, I hate to put so much on you, Hugo, but sort of that first, you know, sort of negotiating at sort of the seed round, the family office round, maybe the Series A, that first sort of, those first approaches, maybe if you haven't done it before, or if it's, you know, you might have a few investors on from your early stages and you're trying to negotiate. You know, how do you think about, you said a little bit about, you know, it's easiest when you have your existing investors are going to, you know, come to this new round and lead the new round. But for most companies that I've worked with, at least, it seems like when you're making that jump from a friends and family round to an institutional round that first time, it's not likely that you're going to be able to go back to the friends and family to raise that A round, say. There'll be some point you have to make that jump. And one question that's always sort of come to me, because I'm actually dealing with this right now, trying to get a deal closed today and yesterday, and I've for the first time in my experience, I've been doing a lot of the phone calls and emails to the existing investors to try and communicate and message the new financing with those people. And for me, this is, you know, as a lawyer, it's been a little bit tricky because I'm trying to make sure I'm, you know, representing the company the best I can, but also managing the relationships the best I can. And it's not really what I'm the most experienced at. And I imagine in your shoes, that's really, you know, a big part of your job. And I'm curious sort of how you think about making those calls and when you think about socializing with your existing investors, the new deal.
Well, to start with, I think, especially when thinking about existing investors, and especially when thinking about those family offices and individuals that are going to be supporting you in the early days, reputation is the most important factor. I think there, the way I look at negotiating a deal or trying to get them further involved with the company, and obviously you always expect that when somebody is going to invest you in the first place, that they will have kept a little bit of dry powder so that they can continue to invest in the company and support you through that next round where you're going to be negotiating with somebody else. But if you have let's say 50% or 60% of the commitments coming from your existing pool of investors, that negotiation is going to be so much easier with a new investor. So that's the first thing. Then in terms of communicating with investors and bringing out the new opportunity for investment, I think the way to approach it is to be always transparent, keep them in the loop about how things are going. No matter if it's good news or bad news, there's always a time where things are not as easy as one would like them to be. So you have to also be transparent about those times, and they will appreciate it. They will support you. That's one of the things that I found, that if you find the right investors, they will always support you no matter what, because obviously they feel invested in the company. They feel like there's something like they have stake there. So they also wanted to succeed. But what I typically do is quarterly updates for investors, where I'm again very transparent, not only on the operational side, but also how conversations are going with other investors, and how we're looking at our burn, and when do we think we're going to have to raise again. So they are always ready and prepared to just support a company when the right time comes. And then a round of funding is at least going to take 6 months, so you have plenty of time to actually get on the phone with them, send them emails. They will want to see updates. They will want to see more financials. There's always one more thing they want to ask for. So there's plenty of time through that 6-month period to finally get them excited. When trying to close a new round, I've also found that existing investors will most likely support you no matter what. To bring in new investors is always a little bit more challenging, because there will always be people that will say, I'll invest, but I don't want to lead, but I want to see who's going to lead the round. And that challenge is always, you can have a great syndicate, but the challenge is going to have to is finding that the right lead, where you feel like you're supported, that you're not giving away a lot of those non-economic terms that we were discussing, and that in exchange, these are people that are going to give you the validation that all the other people coming into the syndicate are going to need to actually make the final decision. A lot of people I found, a lot of investors I found, especially when moving into Series A, where it's the first professional or the first professional round, let's say, there are a lot of investors that are followers and very few that are willing to lead. So I would say that that's the most complicated round that you can go through. So again, my advice is try to keep your existing investors updated, be transparent with them, think about what's best for them, maybe not only for you but also for them, because your reputation is on the line, and if you end up having to start a second company, it's good to have those investors believing in you and continue to support you, and trying to have at least 50% of that commitment coming from the inside, so you have a stronger capability to negotiate with the new investors coming in.
Great, thanks. I think that's incredibly helpful advice, and it's funny, the more I do this, the more I see these sort of scenarios play out, and I think several of the things you just mentioned have come up in my practice recently. Seeing a company, a founder who's run one company until it became apparent that a product wasn't viable, told investors who were committed and were ready to send checks, the deal was entirely negotiated, told them the day before closing, this isn't going to work, we're not going to fund this product, we're going to go back to the drawing board and start over. And those investors came back in his next company, and it was over a year later. This was, a long relationship that he built, and it was a really excellent experience seeing someone who'd been willing and courageous enough not to take the money when he really needed it, to tell his team that they were going to have to stop this project and they'd have to go back to the drawing board. But I think taking that step and being willing to make that decision was really what secured his future success and financing, was that people trusted him. They knew that if he had a product that wasn't going to work, they would know about it. And so if he told them it was going to work, they knew it would. And that, I think, really built a lot of trust and helped him to build a much stronger coalition of investors the next time around. Because those who were coming from the last company really trusted him and were able to give a good sense to the new investors that this was somebody to trust. So I do think that's a really, really good point. I do want to make sure that we're including our entire panel in the conversation, and I think one way we can broaden that discussion is, you mentioned that it can be tough to find an investor who wants to lead. It can be a little more challenging to find money that wants to come in and take a significant risk and a big bet on your company. And one way that I think a lot of investors, in my experience, get comfortable with that is to put someone into the company that they trust, whether it's someone in a sort of professional CEO role or in a CFO position or some other sort of officer position, but also in almost all cases, someone in a board capacity, whether it's director or an observer seat. And along with those decisions usually comes some form of compensation for those individuals. And so I think that when you start to think about bringing in professional investors and bringing on professional executives or board members, it very quickly becomes a question of, and often also in life sciences companies, scientific advisory board and strategic advisory board positions, it often also becomes a question of equity comp and how are we going to incentivize people at an early stage in our company, people who can command high salaries in the sort of big pharmaceutical and biomedical market, how do we get them excited about joining our startup company and what's sort of the upside for them. So I guess I'll turn first to Paul and see if you had any experience with sort of executives moving from the world of big pharma, big business to the startup world.
Sure, yeah. A lot of our customers are executives of public companies, and one of the great things about a public company is the stock is liquid. When they go from public company to a private company, all of a sudden they're used to doing strategies or taking advantage of the liquidity of that stock. When you're in a private company, there's no liquidity, but there are taxes. So if you're going to grant stock or you're going to give out restricted stock, when that stock vests, there's taxes that are due. And in a public company, you can easily sell that stock or turn that stock in to cover the taxes. So what happens in a lot of private companies, you're giving out options instead. The problem with options, they're expensive from the business owner's point of view or the founder's point of view because you're giving up equity. But they're also expensive on the exit. The tax consequences of an option that's exercised at exit is very expensive. It's all income taxes. So one of the things we try to focus on, and again, this is only for the very sophisticated executive, is helping that executive try to reduce the taxes on exit. So if you're giving out ISOs, options, we're seeing now, recently, a lot of these option plans are allowing early exercise of ISOs. So you can exercise that ISO, he or she has to buy the stock to own it, so it's somewhat expensive. I wouldn't recommend this for any rank and file employee. But if you have a sophisticated executive who you're bringing on to grow your company, they can understand how this works. And they can exercise the ISO early, hold it, and then when the exit comes, as long as they hold the stock for a year after they exercised it and 2 years after the grant, they're subject to long-term capital gains, which is half of what you're paying in income tax. So it's a very powerful tool that we use for our, again, high-level, sophisticated executives and helping them monetize their exit as efficiently as possible.
No, I was going to say to Paul's point, though, I mean, it is a really risky strategy. In other words, similar to that, I often see companies loaning executives money to cover the costs of an 83B election, which is a tax election that's made early on and kind of can help you lock in all future appreciation as capital gains. But, if the company goes belly up, as unfortunately many companies do, the loan, in order to be treated as a loan, has to be at least 50% recourse to the person's individual assets. And what that means is if there's a bankruptcy and the creditors come knocking, your loan to the company is an asset. So imagine a situation in which you've borrowed $100,000, it's 50% recourse. So not only are you out of a job, not only do you not have any value from that stock, the company's creditors are coming to you and saying, pay me $50,000. So I just wanted to underscore exactly what Paul was saying, which is that this is not for the faint of heart. I mean, typically when I see options used, there is nobody sort of realizes any value or incurs any taxes until the change in control happens or until there's an IPO, because it's just too risky and too much of a financial burden, especially if your cash compensation is not going to be as high as what it would be if you weren't working for a startup. So I just sort of wanted people to keep the risks in mind here. And Paul, I don't know if you had more to say on that.
Yeah, I agree. I mean, this is only for the executive who fully understands it. We would never recommend a client to borrow to pay taxes. There's an interesting new equity comp program that just came out this year from the Jobs Relief Act. It's called the Qualified Equity Grant. And again, I would be very careful if you hear anybody talking about these. It's actually an 83I election. So what Joe was referring to is an 83B, where you pay your taxes at the time of the exercise, even though you're not vested on the shares, fully vested, and then your long-term cap gains clock starts ticking. And be careful with this new program. It's an 83I election. And this is really for the rank and file employees, where when the stock, they're actually for RSUs, restricted stock units. When that stock is granted, they can actually elect the 83I, and that will allow them to put off their taxes for 5 years. So the loan is not to the company, it's the loan to the federal government. So you can have a company that has a couple of up rounds, while your rank and file employees are, electing this 83I, which looks really good on paper. Company goes south, doesn't work. Now they owe, $100,000 to the government in taxes, even though the stock was up and then went down. So I'd be very, very wary for anybody who's not super sophisticated. Again, if you're attracting a CEO to your company, most likely they've been through an exit before, they understand these. Make sure they consult with their, obviously, tax attorney. These are all tax strategies first, and then investment strategies second. But definitely make sure that executive has understanding. But if you're going to offer an option plan, ISO, and you have a sophisticated executive team, I would definitely consider allowing early exercise of the ISOs. And again, stock grants, they're taxed at vest. Those are very expensive. So if you're offering restricted stock, be wary that there's going to be a taxable event on even though it's private, it's still a taxable event. So if you're an executive vested on $100,000 worth of stock, you have a couple of nice rounds. That's $40,000 in taxes out of that executive's pocket. He might not be too happy when he finds out that he owes $40,000. The ISO gives that executive flexibility to pay the taxes if he or she chooses to. And with the stock grants are very expensive tax-wise. You're going to borrow from them. But again, just to Joe's point, this is not for the faint of heart. They've got to believe in the company, and they've got to believe in an exit. I suppose if you're hiring a new executive, that executive, he or she is sure that things are going to work anyway, I suppose.
So I would also like to add and this is, you guys are the ones that know about the law and taxes, and I don't know much about that, but I know about the part of running the business. So when I would say, obviously, executive compensation is very important, and equity is a big part of it, stock options. My advice to the ones that are in the early stages, like I am now, with Spiral Therapeutics, is that obviously you're going to want to compensate your employees, your executives, but the first even before allowing them to early exercise or doing anything like that, just make sure that you're giving the equity to the right person. One thing that I've encountered myself is having to buy equity back or stock options back from somebody that didn't happen to be the right fit. And equity, you will see especially us that are in biotech. I'm in San Francisco, so I see my wife works in tech, and I see these tech companies that start generating revenue very, very early. So their equity remains over time because they are able to bring other revenue sources beyond the investors' money, right? So, but in the case of biotech, where we are constantly fundraising, your equity portion always you always see it going down. So you have to be very careful with whom you're giving your equity to. And in this case, my advice would be, or something that I typically do is try, once you identify, especially in the early stages of a company, once you identify somebody that you think could be a good fit for the company, maybe offer them a consulting role for a few months, see if it's a good fit for the company, see if you get along, even if it's a little bit more costly than having them on the payroll and giving them equity that today is not worth much, but maybe tomorrow will be worth a lot. And then once you actually find that they are the right fit, then that's the time when you can start negotiating how much of their involvement that represents and how much equity do you think they deserve based on their contributions to the company. So that would be my advice to those who are in the early stages, like I am.
And Jonathan, I'm sure you've seen this happen in your travels, but what you don't want is a situation where you've given out a ton of equity, pre-financing, right, to the wrong people, and then your money comes in, and they're like, well, you've already depleted so many, you've already diluted this so much. You're not giving it to the right people. What are we going to do here?
Yeah, I think that it's interesting that this discussion has generated a lot of leads that we can chase down. I'd like to get to most of them. I guess to that point specifically, I think very important for all early stage companies to think about is sort of what's the size of an option pool or an equity pool that you want to create for your incentive plan. Sort of if you're looking at just sort of what's market for companies at the seed through Series A round, it's probably somewhere between 5 and 15% of equity in a pool, very much heavily weighted towards the lower end of that. Which means at any point in your life cycle, you should be targeting somewhere between 5 and 15% for equity compensation for individuals who are sort of non-founders. Founders obviously would be taking a much larger share at the outset and then being diluted in subsequent rounds. And bear in mind that every single new round of financing will dilute the existing pool that's outstanding. And so if you give someone a 5% interest in your company before there's any outside money in, and then you sell 50% of the company to investors eventually, that 5% will come down to somewhere around 3.5% if you've sold another 50% on top of it. So there will be significant changes in the numbers of the percentages that people hold as you grow the financing of the business.
One quick point that I just wanted to make, and I've been having a lot of success with this with some early stage clients, is actually using, it is strictly speaking cash compensation, but really what it is, it's what I call it as a change in control bonus pool or an IPO bonus pool. And the way it works, it keeps your balance sheet, your cap table rather, completely clean. But essentially what you do is you say, okay, there's going to be 1,000 units in this pool. And when there's an exit event, you are going to get a proportion of the cash proceeds based on your interest, based on the proportional amount of units that you hold. So if you have 10 units, you get 1% of the pool. And the idea is that below a certain level, the pool would fund it all, and then for the next 50 million, it would fund it 10%. For the next 100 million after that, it would fund it 20%, or you can arrange it however you want. But really, I mean, at least in my experience, most of the people who are getting equity really like the idea of equity. Like options are sexy. People like them. But, people aren't really going to be controlling shareholders or have any real huge interest in voting.
I just jump in there and say, if there's someone who's in your employee option pool who does want to have a controlling interest, that might be a warning sign. That's usually not a great thing if employees are trying to be too active in voting from a management perspective. Now, if you're the employee, that you might view it differently. But in our experience, generally, if an employee is too eager to exercise their voting rights, it's often a sign that there's going to be some friction going forward.
Yeah.
Sorry to...
No. I mean, I guess if the ultimate goal here is to produce value, and as Paul was saying, people generally don't want to incur taxes before there's a liquidity event. Really, they're never really going to participate as shareholders in your company. So, I mean, if I'm an investor, I would think that having a clean cap table would be preferable. And a couple of clients have done this recently. One just had an exit event, and it was really smooth. And when the company was being sold, we didn't have to deal with terms in the purchase agreement about what's going to happen to the equity. Is it going to roll over? Is it going to be cashed out? Just something to think about as an alternative to doing something that's strictly equity.
And I think to sort of piggyback on that, because I know we have a range of experience in the room, I think it might be helpful to just kind of quickly run down what types of awards you might be thinking about giving, and then, since I think we're talking a bit here today about what's market and where trends are moving, to give a little bit of our sense of what companies are doing. And I know, Joe, from our conversations, from what you just said, it sounds like we're seeing a little bit more and maybe encouraging some of our clients more to move to these sort of cash bonus, exit bonus kind of plans where possible for the rank and file employees. I know from Paul's commentary for the more senior professional executives that might be coming on, who might have a significantly stronger incentive to seek favorable tax treatment on exit. That might not work as well, but
Actually, John, we've actually seen structures where that bonus pool can be set up into a deferred comp plan. So when there's an exit, everyone has a choice to take an election to take that money. If you have an executive who's got options, is already paying a bunch of taxes on the exit, we can actually structure that bonus pool to roll into a deferred comp plan for a certain amount of time. Again, it depends on how long that executive plans on being with the new company. A lot of times you'll see the buyer of the company, this is more for private, family-owned businesses, the buyers don't want the owner, they want the executive team. So we'll structure a plan where the executive team gets this bonus pool based on a percentage of the sale or differential between when the plan was put in place and when it was sold, almost like a stock option. We call it a 4-man stock option plan. Maybe there's only 3 or 4 executives, there's no reason to get a 490 every year and develop a big plan. So it's actually very efficient, very clean. But when that company gets sold, these executives all get the asset, and you can actually structure it that they may have to stay on with the firm for a year to make sure it's an easy transaction. It's a lot better than an earnout, so they have to stay on for a year, which is calendar year, and they get their money, and then it's deferred into a year, or they can choose to roll it into a year. It's a deferred comp plan, so it's very similar to the bonus pool, and then instead of paying the taxes on exit, you can actually defer it as well. And you can write that into the plan to make sure it's clean. So you have a 30-day election at exit, after the transaction, and then you can decide to defer it or hold it. So we've seen where you get equity comp and deferred comp at the same time. So it's very, very dynamic, and most importantly, it's the executive has the choice. That's what I like. Again, I think of it from a financial planning perspective. I want my clients to have choices. So.
Did we have a question?
Yeah, I've seen plans like that written in during M&A negotiations. Are you suggesting writing a proactive plan like that earlier on, long before there's any M&A in process, or just kind of missing that?
Yeah,
I think that, yeah.
Yeah, I would say I wouldn't do it pre-Series A, but when a Series A comes in, yeah, it's something you want to get your investors on board with, but yeah, that's exactly what I'm suggesting.
Yeah, I think to that point too, it's important to think about the timing of when and how you adopt various plans and issue different types of equity awards. And I think one thing that most entrepreneurs deal with at some point, and I think I might have to lean on you here a little bit, but I think that when you're just starting the company, I think the incentive is just to sort of get things done as fast as possible, as simple as possible. Founders get straight equity, no restricted agreements or anything like that. And as you build the team, build the product, and you're growing and you're getting a little bit more financing in from outside, that's when you take the time to step back and think more clearly about what your plan is and how you are granting this equity. So I'm curious from your perspective, sort of at what stage do you start thinking about we should adopt an equity plan, we should bring a lawyer and consultants in to talk about this, or how do you think about that?
In my particular case, I started very early on because so actually the first thing I did was bring in a chairman, and he was well connected with a law firm, and he said just talk to them, and also I'm sure you guys also have ways to support investor or early companies where like maybe there's not that much cash available because they are still fundraising, but you can just maybe offer some services based on future closings or something like that. So these are things that we've tried to negotiate before. So basically try to have those things in place as soon as possible. I think that's going to be important, and once you start discussing with somebody, you want to be able to act fast. If you identify a potential team member that you want to bring in, you don't want to have to delay that discussion by a month or two because you're just having to get the lawyers draft the documents, then the board approve what's been drafted, and then go back to the employee because maybe by then they're already tired of waiting, right? Another thing when discussing about like term sheets and terms, and I think that's where the investors come in place too, is what I found. Right now I'm a sole founder, but what I found useful, and especially thinking about those later employees that will be joining later, is like just setting an example of what are the general terms for the company, but setting that example in yourself. So, for example, in my case, I decided to restrict my own stock. And I just went back to when I started working on the company, and I had a 4-year plan, but just to say to everybody else that this is how things work, and this is the terms that we're all agreeing to. I think that's also comes in handy when you're negotiating with somebody and they try to push a little bit more, or just reduce their vesting terms, and you're like, well, I have these vesting terms, so like you're gonna have to accept what's the standard for the company. So I think that's also useful, and investors will appreciate it. And if you're committed to what you're building and you have a long-term vision for the company, that shouldn't be a problem. So that's also another recommendation that I would make.
I don't think we'll complain about suggesting that you go to lawyers early for this. And I have to say, I think it is the right move. As you said, there's most law firms, certainly McDermott, Will & Emery, offer early stage company sort of packages where you'll be able to get some consulting up front and work done up front on a deferred fee or limited fee basis. For McDermott, it's the LEAP program, and I'm certainly happy to give information about that if people are interested. But these are the kinds of things where it's difficult and costly to go back and fix mistakes. As anyone who's been through early stage company through financings and exits before might know, if you issue options or other awards at a valuation that wasn't supported by a 409A valuation, and later there's questions about whether they were undervalued, there can be costly tax consequences for the recipient and also for the sort of administrative and potentially tax consequences for the issuer as well. It also can be a diligence issue when you're getting new money in and they're trying to look back at the history of awards that were made. We certainly see oftentimes sophisticated investors in a B, C, D round or a potential acquirer having questions and potentially slowing things down if it doesn't look like there's clear support for all of the awards that were made for the valuations. And so, I think this is one area where if you're going to sort of be allocating your precious resources for legal at an early stage, this is one where there's a lot of return on your investment. And it's a plan that under tax law, as I understand, can last you 10 years. So you don't have to revisit this that often. So once you've set it up and you've got a plan that you're comfortable with, it's one that you can continue to use for a long time. So it's not like a thing you have to keep coming back to that often. And I guess I'd like to open up to the panel a little bit as well, just to say, in my experience, most companies, most employees are most familiar with options, and then also with restricted stock. But I've heard other terms thrown around a lot here today. We've talked a bit about this cash bonus plan. I've also heard restricted stock units mentioned. And there are other sort of phantom equity and exotic concepts that get thrown around sometimes too. And I guess I
was just going to say, one thing I think we definitely should cover, and how many people here, to see if this is relevant, how many people here have entities that are taxed as partnerships, that are
so LLCs or partnerships?
LPs. Okay, so a few, but one golden rule for LPs and LLCs is that you should not grant stock options. You should grant profits interests instead. Since there's only a couple people here, I won't get into that in a ton of detail, but I'm more than happy to talk about sort of non-corporate equity compensation structures if anybody wants. Jonathan mentioned restricted stock units as well, and despite the name, they're fairly different actually from restricted stock. Basically what a restricted stock unit is, you can think of it this way, it's a promise to pay you a share. Okay, so with restricted stock, when you vest in that stock, there's a tax event and the share is yours free and clear. When you vest in a restricted stock unit, the company doesn't actually have to give you a share of stock at that time. Most of the time, for kind of arcane tax law reasons, which again I'm happy to get into if people need a good nap before lunch. Most of the time they do wind up giving you the share of stock, generally within 30 days. But what you can do is you can say, you know what, I'm not going to give you that share of stock in 30 days. We're going to wait until there's a change in control of the company. And when you do it that way, you pay FICA taxes, Social Security taxes, when the restricted stock unit vests, but you don't pay income taxes until the share is actually given to you. So you could have a situation, right, where an employee vests in $25,000, well, let's say 25,000 restricted stock units after a year of employment, pays whatever minimal FICA taxes due, right? Because your company may not have really appreciated that much yet. And then years down the road, when there's a change in control, then there's the payout of shares, and then the tax event happens. So it's another type of compensation to keep in mind. The big disadvantage is if you wait that long, all of that money, those shares are all going to be taxed as ordinary income, right? Because you didn't really get them. I mean, you didn't get them until a split second before the deal happened, and you're obviously not going to have any capital gains in that nanosecond between when they're distributed and when they're purchased by a buyer. So you see that to some degree, but not a ton because of this desire to get capital gains.
Yeah, I think that's sort of my impression from sort of dealing with a lot of companies in the space is that employees seem to understand options and restricted stock the best of all these options. That from the company perspective, options are often much more preferable than restricted stock because everyone gets better tax treatment from day one, and you also don't have to have as many people exercising them early or before there's an exit. And so you're not diluting your voting cap table to the same extent. You don't have to go and get consensus from people who, from a lot of small holders before you close a deal. And then after sort of the option or restricted stock, I think a lot of people start to nod off when you try to describe what they are. And I think a lot of employees just don't really understand beyond that. And so I think that having a plan that encompasses what the company wants to do the best, that you can work out with lawyers at the management level is great, and then messaging that to your employees as as best possible to sort of put it in terms they understand is sort of the next step beyond that. I think that's somewhere where seasoned CEOs, finance advisors, people who've been through this a number of times can really help you, even more than the lawyers certainly, to message this to your employees and potential hires to make sure that they understand what they're getting and that they're not scared off by some concept that doesn't look the same as what maybe Google done 10 years ago. I think those kind of things are important to bear in mind when you're designing a plan and thinking it through. And I do think it really is sort of a design process. You're not just picking something up off the shelf. Usually when you're trying, especially at a Series A to a Series B round, you may want to really kind of drill in and see what works best for more executive level employees. So we have a question here, and I also wanted to say we have a few minutes left. I did want to open the questions, so let's start it off.
Yeah, just a quick question. So you had mentioned before about vehicles for pooling stakeholders essentially into one pool, like for the units and that sort of thing. If the rights are granted to that entity at the beginning, the entity essentially has the level of appreciation itself, and then it's granting the stakeholders at some point with the benefits of that, right? With the cash benefits of cashing out, essentially.
Yeah. So,
but my question was essentially, can you create that in a way so that the stakeholders that are involved there are capable of dictating when they want to pull that out? Meaning that it's not necessarily a change of control event where they get paid out for this cash bonus, but maybe that change of control can happen and this entity can continue, but a year or two later, okay, now I want to withdraw. Person A can withdraw, then person B can withdraw at separate times. Is that possible or not?
that would be challenging. It could be done, but it would need to sort of be baked in before the change in control.
Right, it would have to be
In other
designed
words,
that way. Yeah.
yeah. So what it would need to say, for example, is Mr. Smith, you get 10 appreciation, 10 incentive units. 5 of them will pay out on change of control, and 5 of them will be deferred until a year after.
You have to dictate the time periods. I was thinking more along the lines of
Like
where
just
the person
take-
could choose when to exit.
Yeah, for again, arcane tax reasons, if you do that, you're subjecting yourself to an additional 20% tax. So it's, yeah, you realistically, you wouldn't do that, but you could say, hey, look, like, you know, my daughter Samantha is 10 years old now. She's going to be going to college in 8 years. Well, she's 14 years old. She's going to be going to college in 4 years. You know I'm going to really want this money, you know, between the ages of 18 and 20, when she's 18 and 22. So you could, you know, figure out ahead of time when that would happen and plan a particular
Right,
tax
and
year.
then every single person would have to have their own set of timelines that would be pre-baked into the.
You could give people the option to defer, and if they don't make a deferral election, then it's just paid out on a change of control. So you could do it that way. Frankly, unless there's a huge upswell of employee desire for it, I think it's probably more trouble than it's worth, but it could be done.
Okay.
Yeah.
Thanks. Early stage valuation is obviously really, really tricky. How often do you see, if ever, the equity being set during future investment rounds of Series A, and then the investor would get equity plus a bonus because they invested early?
So, just so I'm sure I'm understanding the question. So you're suggesting that you wouldn't actually make these equity awards until after the next round, so you have an opportunity to value the stock then, and then you'd make these awards and then maybe true them up for the increase in value since that last.
That's it, yes.
Okay, yeah, and that's something we actually see a lot now, both because people want to delay getting evaluation and because for many reasons, oftentimes awards aren't made sort of very quickly after someone gets hired, or there's a discussion about what the valuation is, and then they get a new 409A valuation that says, oh, actually, your company is worth more than we thought, so we can't give you the valuation we wanted to. And I actually, Joe and I were recently talking about this. I'm going to let Joe sort of explain how he thinks that we deal with
Yeah,
that.
so it's a tricky question, but so let's just say you wanted to grant somebody 100 options and they started when the stock was worth $5, and you've been going gangbusters, and now the valuation comes in at $20, right? So for the same reasons I was talking to this gentleman over here, if you grant the option at $5, an exercise price of $5 when the stock is worth $20, you're basically saying, okay, employee, pay 20% more in that differential. So essentially they're $3 out of pocket, right? Like on top of all the other taxes. So you don't want to do that. But what you can do, and what we've been seeing happen more and more often, is saying to the employee, okay, look, you know, we meant to grant this to you earlier. Here's what we're going to do instead. We're going to give you 100 options with an exercise price of $20. And what we're also going to do is give you a right to receive 100 cash payments of $15. And those cash payments would vest on the same schedule as the stock options, and then would be paid out either on vesting, or if you wanted to, you can structure it this way, on a liquidity event. And so the idea there is you're sort of creating, if you want to look at it this way, like a synthetic option, or a synthetic value to cover the lost value of the earlier, of what person would have been able to exercise the options at had they been granted earlier.
I was thinking more about from the investor's perspective and not employee perspective. Would that be the same? And before you even know
So,
what the value is.
I think there, probably what you're referring to is convertible notes. It's a debt that you can raise and it converts at an equity event later on. Is that what you're?
Potentially, if that's what it's called.
Yeah, yeah. So that's a tool that I think it's used probably early on when you don't want to define the valuation. I think there are two ways to. So I think that the three main components of a convertible note will be a potential cap, a discount, and the interest. And then the rest of the note basically is going to potentially will define that the investors will get the same terms as whatever the preferred shares get when the equity round happens. So my experience is that in an ideal world, we would like to set or offer a convertible note with no cap and just give a discount based on whatever future valuation might come. I think that's tricky, and not a lot of people will be willing to accept that unless they know that you have a very clear plan for equity conversion and you have an idea on what the future valuation will be, which is precisely what you don't want to get into. So basically, you will have to define some sort of cap. the cap, it will depend on who you are and how many companies you put together before this one, and who you have around. But what I found is usually in the earlier stages, valuations around between, like I would say, 3 and 10 million is probably what would make sense, at least for a biotech company in my experience. So the other tricky part about convertible notes is that they can sit there for a while, and then you can wait until your equity event, and investors will usually not complain because that's also producing some interest for them. In terms of interest, I mean, you guys will know better, but I think interest can range from like 2 to 8, usually on the higher side. I've managed to negotiate lower interest, but a 4% interest over time, it accumulates, and it also damages your future equity. So you want to convert as soon as possible because otherwise you're going to be giving equity away. So all those things are things to consider. But it's a very useful tool and something that is being, like investors accepted, and there's no issues with that. Then the convertible note is probably the most traditional and easiest way to do this sort of rounds. There's the SAFE agreement, which I don't want to get into because I don't like, and I've always tried to stay away from it. I don't know what our lawyers here will think about it, but
I'll also stay away from too much discussion on that. I'm happy to talk at length about convertible notes and safes after, though, if there's questions about those sorts of investment opportunities. We actually are seeing a lot more safes on the East Coast these days. They originated out at Y Combinator, if you're familiar with that incubator, but they've made their way east, and so you may have been seeing some proposals on that.
What's it? I've got convertible notes, but what's it say?
It's as I said, I can talk more after, but it's a sort of a contract that looks a lot like a convertible note, but without interest and without the debt-like features. It's a semi-exotic, intended to be simpler concept than a convertible, but it ends up not really being.
Okay, good.
In my experience. We are a little bit past 11:50, so if people wanted to run and get lunch, I don't want to hold anyone, but we're happy. I'm happy. Joe's happy. I won't speak for our panelists, but happy to answer more questions if there are.
Sorry, just one more about the SAFE, because I'm curious where the negative is, because it seems to be something we can negotiate really any kind of term, and it's just a promise of future equity. And so where's the negative on that? I'm curious.
If you're asking me, it depends very much on who the party is that's concerned, right? So if you are the company, I think in a lot of ways it can be better. It can be. It's not debt, technically, although it probably gets onto your balance sheet in very much the same way that a convertible note would.
Yeah, it's usually a short term time where you're finishing raising the rest of the rounds.
Yeah, I mean, that's a big question. How the actual instrument is designed plays a lot into whether or not it's a good idea and whether or not it's how risky it is. But certainly from the interest perspective, it's
I think you also don't want to limit your ability to bring in investors, and a lot of investors won't be comfortable with that format. So I think the simpler you keep it, the easier it will be to get investors on board.
Yeah, I think that's a good point too for this coast. If you're looking mostly at investors in the Boston area, they may be less familiar with safes than those in Silicon Valley. So it may be a more tricky thing to negotiate around for a future round. But that being said, I think you're right. It is a simple contractual obligation that doesn't look quite like the convertible debt, but it is a little bit more exotic, a little bit less well known. Again, more than happy to talk about it a lot more than that, but that's my high level take on it. Anything else before we break? Okay, well, thanks very much, and please feel free to come up and.